Payment systems, clearing houses, central securities depositories, and securities settlement systems are key institutions in the U.S. financial market infrastructure. Payment systems in the United States include mechanisms for processing both wholesale and retail funds transfers. At the wholesale level, two large value electronic funds transfer systems settle the bulk of the dollar value of all payments in the United States. At the retail level, non-cash payments are processed over a number of systems, including check clearing systems, automated clearing house systems, and credit and debit card networks. While a significant but unknown number of payments continue to be settled in cash, almost all non-cash payment instruments, including checks, settle electronically. In addition, innovation and competition have facilitated the use of new instruments and payment channels that rely increasingly on electronic payment mechanisms. Central securities depositories and securities settlement systems facilitate the safekeeping of securities and the guarantee and settlement of different types of securities transactions. Generally in the United States, a single system acts as both a central securities depository and a securities settlement system for a specific set of securities. Central counterparties, CCPs, facilitate the clearing and guarantee of various types of financial transactions, including securities and derivatives transactions, traded either on exchanges or over-the-counter OTC. Generally, each CCP clears a specific set of contracts. In recent years, trade repositories have been developed to collect and maintain information on various financial transactions, in particular those involving OTC derivatives. Trade repositories have improved the overall transparency in the OTC derivatives markets. As the Central Bank of the United States, the Federal Reserve provides certain payment and settlement services to depository institutions. Private sector operators of payment, clearing and settlement systems also provide such services to financial institutions. Several government agencies play active roles in the oversight and regulation of private sector payment, clearing and settlement systems, most notably the Federal Reserve, the Securities and Exchange Commission (SEC), and the Commodity Futures Trading Commission (CFTC). The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 (DFA) provides additional authorities for these or other relevant regulatory agencies over payment, clearing and settlement systems designated by the new Financial Stability Oversight Council (FSOC) as systemically important. 1. Legal and regulatory aspects. 1.1 The general legal framework. Payment, clearing and settlement systems in the United States are governed by statutes, regulations and case law at the state and federal levels. The legal principles relevant to a particular system generally depend on the method of payment, the type of transactions cleared and settled, and, in some cases, the status of parties to a payment. Within the relevant governing law, rules and membership agreements of private clearing and settlement arrangements provide a contractual framework for payments activity. For payment services operated by the Federal Reserve regulations and operating circulars specify the terms and conditions under which services are provided. In addition, the DFA, enacted on the 21st of July 2010, was one of the most significant pieces of legislation affecting the U.S. financial regulatory framework in many years. Several parts of the DFA related to payment, clearing and settlement systems are discussed below. At the state level, the Uniform Commercial Code (UCC) provides a set of model statutes governing certain commercial and financial activities, including some banking and securities. CPSS, Red Book 2012-477, Market Transactions. The following articles of the UCC pertain to payment and settlement activities. Article 3 Negotiable Instruments, Article 4 Bank Deposits and Collections, Article 4A Funds Transfers, Article 8 Investment Securities, and Article 9 Secured Transactions. These articles, sometimes with local variations, have been incorporated into the laws of all the states. The Federal Reserve's Funds Transfer System, the Fedwire Funds Service (Fedwire Funds), is governed by Federal Reserve Regulation J, which defines the rights and responsibilities of financial institutions that use Fedwire funds as well as the rights and responsibilities of the Federal Reserve. Federal Reserve Operating Circular (OC) 6 covers items such as Fedwire funds operating hours, security, authentication, fees and certain restrictions. OC 6 also requires each Fedwire funds participant to enter into a security procedures agreement with its Federal Reserve Bank (Reserve Bank). In addition, OC 1 governs account relationships and OC 5 governs electronic access to Fedwire funds. A depository institution sending payment orders to a reserve bank is also required to have sufficient funds, either in the form of account balances held at the Federal Reserve or daylight overdraft capacity. Funds transfers made through the Clearing House Interbank Payments System (CHIPS) are subject to CHIPS rules and procedures and the laws of the state of New York. Both Fedwire funds and CHIPS operate under the requirements of UCC Article 4A.1. Federal Reserve Regulation CC regulates the time in which a depository institution receiving a Fedwire funds or CHIPS funds transfer on behalf of a customer must make those funds available to its customer. The Federal Reserve operates its securities transfer system, the Fedwire Securities Service Fedwire Securities under OC7, which covers issues for Fedwire securities that are similar to those covered in OC6 for Fedwire funds. As with Fedwire funds, OC1 governs account relationships and OC5 governs electronic access to Fedwire securities. Transaction enforceability is governed by state securities and commercial codes, in particular UCC Articles 8 and 9.2. Articles 3 and 4 of the UCC form the legal basis for paper-based check transactions in the United States. In addition, the Expedited Funds Availability Act of 1987 (EFAA) and the Check Clearing for the 21st Century Act of 2003 (Check 21 Act) are important federal statutes governing check collection. The EFAA grants the Board of Governors of the Federal Reserve System, the Federal Reserve Board, or the Board authority to improve and accelerate the collection and return of checks among depository institutions. The Check 21 Act authorized a new negotiable instrument called a substitute check. A substitute check is a paper reproduction of an original check that contains an image of the front and back of the original check. Under the Check 21 Act, a properly prepared substitute check is the legal equivalent of the original check for all purposes. By authorizing banks to create substitute checks, the Check 21 Act enables banks to truncate original paper checks, process them electronically, and create substitute checks for delivery to banks or customers that do not accept checks electronically. The Federal Reserve implements the EFAA and the Check 21 Act through Regulation CC. In addition to Regulation CC, checks collected through the Federal Reserve banks are governed by Subpart A of the Federal Reserve Regulation J and OC3, which provide rules for collecting and returning items through the Federal Reserve. 1 Article 4A does not address transactions that are governed by the Electronic Fund Transfer Act of 1978, primarily consumer electronic funds transfers. 2 UCC Article 8 sets out rules regarding the rights and obligations of entitlement holders, securities intermediaries, and other parties in both direct and indirect systems for holding securities. UCC Article 9 governs the rights and obligations of parties to a secured transaction. 478 CPSS, Red Book 2012. United States. The rights and liabilities of both consumers and financial institutions involved in consumer electronic payment transactions, including funds transfers through ACH, ATM or POS networks, are governed by the Electronic Fund Transfer Act of 1978 (EFTA) and Regulation E. Regulation E also sets standards for financial disclosure, debit and credit card issuance, access and error resolution procedures applicable to all financial institutions. Other federal laws and policies affecting consumer use of electronic funds transfers include the Office of the Comptroller of the Currency's Consumer Protection Guidelines and the Truth in Lending Act, and Regulation Z issued thereunder, which provide for the disclosure of costs and terms of consumer credit. In addition, the Fair and Accurate Credit Transactions Act of 2003 included protections for consumer financial information, such as requiring merchants to truncate the account number of credit and debit card receipts. Section 1075 of the DFA, which added a new section to the EFTA, directed the Federal Reserve Board to issue rules relating to debit card interchange fees, including a fraud prevention adjustment, network exclusivity arrangements and transactions routing. Federal Reserve Regulation 2 implements these rules, see Section 2.2.2. The Federal Reserve, as supervisor and regulator of certain financial institutions, is the primary federal banking regulator for several payment, clearing and settlement systems. 3. In addition, the Federal Reserve Board, by statute, supervises the Federal Reserve banks in their provision of payment and settlement services such as Fedwire funds. The Federal Reserve Policy on Payment System Risk (PSR) policy addresses the risks that payment and settlement activities present to the financial system and to the reserve banks. Through the PSR policy, the Federal Reserve Board establishes standards for financial system participants to reduce and control settlement and systemic risk arising in payment and settlement systems, consistent with the smooth operation of the financial system. 4. The Commodity Futures Trading Commission is the primary regulator of derivatives clearing organizations, DCOs, which are clearing houses for futures contracts, options on futures contracts, and swaps. To be registered or maintain registration as a DCO, a clearing house must comply with the CFTC's core principles as established in the Commodity Exchange Act (C). Recently, the DFA amended the C to re-adopt and amend 14 existing core principles and add 4 new ones. The Securities and Exchange Commission is the primary regulator of securities clearing agencies, e.g. central counterparties, securities settlement systems and central securities depositories. The SEC standards for the registration of clearing agencies are a set of guidelines that the SEC applies in considering whether to grant or deny registration of a clearing agency. The standards for the registration of clearing agencies also serve as guidance to assist clearing agencies in assessing whether their organizations, capacities, and rules comply with the clearing agency registration provisions of the Securities Exchange Act of 1934, c. 3. See Section 1.2 for the structure of the Federal Reserve System. See Section 1.2.1 for the types of financial institutions for which the Federal Reserve is primary supervisor. 4. The PSR policy consists of two parts. Part 1 sets forth the board's risk management expectations for payment and settlement systems subject to its authority, including systems operated by the reserve banks. The policy also establishes specific expectations for systemically important systems, including compliance with internationally accepted risk management standards for payment systems, securities settlement systems, and central counterparties, as adopted in the policy. The board has incorporated the international standards set out in the CPSS Core Principles for Systemically Important Payment Systems and the CPSS IOSCO Recommendations for Securities Settlement Systems and Recommendations for Central Counterparties in its PSR policy. Part 2 of the PSR policy governs the provision of intraday credit, or daylight overdrafts, in accounts at the reserve banks and sets out the general methods used by the reserve banks to control their intraday credit exposures. CPSS, Red Book 2012-479. Title 7 of the DFA extended the authority of the CFTC and SEC over swaps traded over the counter in a number of ways, including with respect to trading and clearing. Title 7 includes a mandate for the central clearing of standardized swaps. Title I of the DFA established the Financial Stability Oversight Council, which is charged with monitoring and identifying emerging risks to financial stability across the entire financial system, identifying potential regulatory gaps, and coordinating agencies' responses to potential systemic risks. The FSOC comprises 10 voting members: the Treasury Secretary, who serves as chairperson of the FSOC, the chairman of the Federal Reserve Board, the heads of the Consumer Financial Protection Bureau (CFPB), Office of the Comptroller of the Currency (SEC), Federal Deposit Insurance Corporation (FDIC), CFTC, Federal Housing Finance Agency (FHFA), and National Credit Union Administration (NCUA), and an independent member with insurance expertise appointed by the President and confirmed by the U.S. Senate. The FSOC also includes 5 non-voting members who serve in an advisory capacity: the directors of the Treasury Department's Office of Financial Research and the Federal Insurance Office, a state insurance commissioner, a state banking supervisor, and a state securities commissioner. Title 8 of the DFA gives the FSOC the authority to identify and designate a financial market utility (FMU) as systemically important if the FSOC determines that failure of or a disruption to the FMU could create or increase the risk of significant liquidity or credit problems spreading among financial institutions or markets, thereby threatening the stability of the U.S. financial system. 5. In addition, the FSOC may designate certain payment, clearing, or settlement activities as systemically important. Designation, among other things, allows the appropriate supervisory agency to impose enhanced risk management standards and supervision on the designated FMU or payment, clearing, or settlement activity. 1.2 The role of the Federal Reserve. The Federal Reserve Act of 1913 established the Federal Reserve as the central bank of the United States and prescribed the general banking powers of the Federal Reserve. The Federal Reserve has responsibilities that encompass issuing banknotes, providing payment services, acting as the fiscal agent and depository of the United States government, supervising and regulating certain banking and financial institutions, and conducting monetary policy. The Federal Reserve System includes 12 regional Federal Reserve banks located throughout the United States and the Board of Governors in Washington, D.C. The Board of Governors is responsible for the general supervision and oversight of the reserve banks, which are separately incorporated entities. 1.2.1 Supervision of payment, settlement, and clearing activities and infrastructures. The Federal Reserve supervises and regulates U.S. bank holding companies, financial holding companies, and state-chartered commercial banks that are members of the Federal Reserve System. 6. The Federal Reserve is also responsible for the supervision of EDGE Act and agreement corporations as well as the operations of foreign banking organizations in the 5. For the purposes of the DFA, FMUs include payment, clearing, and settlement systems but do not include trade repositories. On the 18th of July 2012, the FSOC designated 8 FMUs systemically important under Title 8 of the DFA. These designated FMUs are The Clearing House Payments Company LLC, Payments Co., on the basis of its role as operator of the Clearing House Interbank Payments System, CHIPS E, CLS Bank International, CLS Bank E, Chicago Mercantile Exchange, Inc., CMEIV, the Depository Trust Company, DTCV, Fixed Income Clearing Corporation, FICC, ICE Clear Credit LLC, National Securities Clearing Corporation, NSCC, and 8. The Options Clearing Corporation, OCC. 6. All federally chartered banks are members of the Federal Reserve System. A state-chartered bank may become a member of the Federal Reserve System by applying to the Federal Reserve. Each member bank is required to subscribe to the capital stock of the Reserve Bank of its district. 480 CPSS, Red Book 2012. United States. United States. Point 7. As noted in sections 3 and 4 of this chapter, several financial market infrastructures are state-chartered banks or EDGE Act corporations and are, therefore, supervised by the Federal Reserve. Title 8 of the DFA strengthens the supervisory and regulatory framework related to payment, clearing and settlement systems in the United States and gives the Federal Reserve Board additional authority to assess systemic risks arising from these systems. Section 805A of the DFA authorizes the Board to prescribe risk management standards governing the operations of FMUs that have been designated as systemically important by the FSOC, except for designated FMUs that are registered with the CFTC as derivatives clearing organizations or registered with the SEC as clearing agencies. These latter FMUs, known as Designated Clearing Entities (DCEs), are subject to the applicable risk management standards contained in regulations prescribed by the CFTC or SEC, respectively. Section 806E of the DFA requires a designated FMU to provide advance notice to its supervisory agency of any proposed change to its rules, procedures or operations that could materially affect the nature or level of risks presented by the designated FMU. The CFTC and the SEC are required to consult with the Board on such notices provided by the DCEs, under Section 807. The Board, CFTC and SEC must examine and may take enforcement action against designated FMUs for which they are the relevant supervisory agency. In addition, the CFTC and SEC are required to consult annually with the Board regarding the scope and methodology of their examinations of DCEs, and the Board may participate in any examination of a DCE. The Board may also recommend that the CFTC or SEC, as applicable, take enforcement action against the DCE. Section 809 of the DFA authorizes the Board to require a designated FMU to submit reports and data in order to assess the safety and soundness of the utility and the systemic risk that the FMU's operations pose to the financial system. 1.2.2 Provision of Payment and Settlement Services. 1.2.2.1 Note issuance. Virtually all U.S. dollar paper currency in circulation is in the form of Federal Reserve Notes (FR Notes). Point 8. Federal Reserve Notes are ordered and issued by the Federal Reserve Board and produced by the Department of the Treasury's U.S. Treasury, Bureau of Engraving and Printing. The Federal Reserve Board compensates the U.S. Treasury for the cost of printing FR notes. The Board issues FR notes to the 12 reserve banks, which distribute FR notes to the public through depository institutions. FR notes are secured by legally authorized collateral, principally U.S. government securities held by the Federal Reserve banks. The reserve banks provide cash services to more than 9,000 of over 15,000 banks, savings and loan associations and credit unions in the United States. The remaining depository institutions obtain FR notes and coins from correspondent banks rather than directly from a reserve bank. The Federal Reserve banks also distribute FR notes and coins internationally, primarily through the Federal Reserve Bank of New York, the Miami branch of the Federal Reserve Bank of Atlanta and the Los Angeles branch of the Federal Reserve Bank of San Francisco. 7. EDGE Act and Agreement corporations engage in international banking and investment activities. EDGE Act and Agreement corporations are chartered by the Federal Reserve Board under Section 25 of the Federal Reserve Act. 8. A small number of U.S. notes remain in circulation. U.S. notes were issued from 1862 to 1971 and remain legal tender. Federal Reserve notes were first issued in 1913 and are currently the only form of paper currency printed and issued. CPSS, Red Book 2012-481. 1.2.2.2 Payment Services to Depository Institutions. The Federal Reserve banks provide a variety of payment and other services to depository institutions. Federal Reserve payment services include the distribution of FR notes and coins, the collection and return of checks, the electronic transfer of funds via the Fedwire Fund Service, FedIC and the National Settlement Service (NSS), and the electronic transfer of federal government securities via the Fedwire Securities Service. Individuals and institutions that do not take deposits are generally not permitted direct access to Federal Reserve payment services, though these entities may use these services indirectly as customers of depository institutions. Section 806A of the DFA, however, makes designated FMUs eligible for Federal Reserve services. Specifically, the board may authorize a reserve bank to establish and maintain an account and provide deposit and payment services to the designated FMU under terms and conditions that the board deems appropriate. The Monetary Control Act of 1980 (MCA) requires the Federal Reserve to charge fees for certain payment services provided to depository institutions, including, for example, check collection, FedIC, Fedwire funds and the NSS. The MCA also specifies that the Federal Reserve is to set fees in such a way that revenues recover the costs of providing payment services over the long term. The Federal Reserve is also required to include in its cost calculations not only its actual operating expenses but also imputed costs, including financing costs and taxes, as well as the profit that would have been earned if a private firm provided the services. 1.2.2.3 Fiscal Agency and Depository Services. The Federal Reserve Act provides that the Federal Reserve banks will act as fiscal agents and depositories of the U.S. government when required to do so by the Treasury Secretary. As fiscal agents and depositories for the federal government, the Reserve banks auction Treasury securities, process electronic and check payments for the Treasury, collect certain funds owed to the federal government, maintain the Treasury's bank account and invest excess Treasury balances. The Reserve banks also provide certain fiscal agency and depository services to other government agencies, government-sponsored enterprises (GSEs), and certain international organizations. 1.3 The role of other private and public sector bodies. 1.3.1 Financial intermediaries. Financial intermediaries that provide payment services in the United States include more than 15,000 depository institutions. 9. These institutions can be classified as commercial banks or as thrift institutions, such as credit unions and savings and loan associations (S&Ls). These classifications determine what services financial institutions may provide to the public and the regulatory structure to which the institutions are subject. Commercial banks accept demand and time deposits, make commercial loans and provide the public with other banking services, including payment services. At year-end 2010, there were around 6,500 commercial banks in the United States. 9. The term depository institution, which is defined in Section 19(b)(1)(a) of the Federal Reserve Act, is commonly used in the United States to refer to a deposit-taking financial institution, or one that accepts deposits. 482 CPSS, Red Book 2012. United States. Credit unions, state and federal, are cooperative organizations of individuals sharing a common affiliation, usually through employment with a particular company or organization or membership in a labor union or church. Credit unions accept deposits of members' savings in the form of share purchases and pay interest, in the form of dividends on the shares, out of earnings. Credit unions also provide loans to members and provide transaction accounts upon which share drafts can be drawn. Federally chartered credit unions may provide and hold residential mortgages and issue credit and debit cards. At year-end 2010, there were nearly 7,500 credit unions in the United States. S&Ls are federally or state chartered and are required by law to make a certain percentage of their loans as home mortgages. They may be organized and owned by depositors, in which case they are called mutual associations, or they may be organized as stock-issuing corporations owned by shareholders. S&Ls can make consumer loans, offer negotiable order of withdrawal now accounts, issue credit and debit cards, and offer certain types of commercial loans. Other savings institutions, such as federal savings banks, mutual savings banks and mutual stock banks, accept consumer deposits and invest primarily in residential mortgages and high-grade investment securities. Like S&Ls, these organizations may be owned by their depositors, in which case they are known as mutual savings banks, or they may be stock-issuing corporations owned by shareholders. At year-end 2010, there were almost 1,200 savings institutions, including S&Ls, in the United States. 1.3.2 Other institutions that provide payment services. Other organizations involved in providing payment services include so-called non-bank banks, payment card companies, and the United States Postal Service. Non-bank banks, or limited service banks, can make loans or accept deposits but cannot do both. Because of this distinction, a non-bank bank avoids meeting the legal definition of bank under the Bank Holding Company Act of 1956. The Competitive Equality Banking Act of 1987 closed this loophole, but non-bank banks in existence before 1987 were permitted to continue to operate under certain restrictions. Payment card companies license credit and debit card trademarks to financial institutions, authorize transactions, and provide certain clearing and settlement services for transactions between banks. Visa and MasterCard are the two largest payment card networks operating in the United States, but several smaller payment card networks are common throughout the United States. Other card issuing companies include national, travel and entertainment, card issuers, and a number of major retailers that issue cards to their customers. The United States Postal Service sells postal money orders, which can be used to make payments. The United States Postal Service issued 121 million postal money orders during 2010. Other entities that play a role in the United States payment system include those that provide specialized payment and settlement services and those that perform standard setting or rule writing functions. In 2010, private organizations providing payment and settlement services in the United States included the following: the Clearing House, several check clearing houses, and specialized financial intermediaries, such as securities clearing corporations and central securities depositories. 10. NACHA, a nonprofit association of financial institutions and regional payments associations, formulates and promulgates rules and standards for processing ACH transactions throughout. 10. The Clearing House provides a range of large and small value electronic payment services, including the Clearing House Interbank Payments System (CHIPS), a wire transfer system, the Electronic Payments Network (EPN), an ACH network, and SVPCO, a check clearing service. CPSS, Red Book 2012-483, the United States. In addition, regional ACH associations provide educational and promotional services to ACH participants. 1.3.3 Consumer Financial Protection Bureau (CFPB), Title X of the DFA created an independent Consumer Financial Protection Bureau within the Federal Reserve to ensure that consumers have access to financial markets and that such markets are fair, transparent, and competitive. The CFPB assumed rule-making authority for most federal consumer financial protection statutes, including almost all of the EFTA, in July 2011. 2. Payment media used by non-financial entities. 2.1 Cash payments. Cash, FR notes and coins, is widely used as both a means of payment for many types of transactions and as a store of value in the United States and internationally. FR notes are issued by the board and are printed in denominations of $1 $2, 5, 10, 20, 50, and 100. Coins are issued by the U.S. Treasury's Mint in denominations of 1, 5, 10, 25, 50 cents, and $1. At year-end 2010, the value of notes and coins in circulation was $983 billion, of which $942 billion were notes. The amount of notes in circulation depends on the public's demand for them. Domestic demand largely results from the use of cash in transactions and is influenced primarily by prices for goods and services, income levels, and population. U.S. currency is also widely used outside the United States both for transactions and as a store of value. As much as 2/3 of the value of U.S. currency in circulation is estimated to be held abroad, primarily in 100 United States dollars notes. 2.2 Non-cash payments. 2.2.1 Non-cash payment instruments. In the United States, the money balances used by consumers and non-financial businesses to effect transactions are generally held as transaction deposits at depository institutions. These typically take the form of demand deposits, such as checking accounts, NOW accounts, and credit union share draft accounts. At year-end 2010, the value of transaction accounts held at depository institutions was $1.1 trillion United States dollars. Savings accounts, money market deposit accounts, certain small and large time deposits, money market mutual funds, and liquid investment assets, such as repurchase agreements and Eurodollar deposits, are less liquid but may nonetheless be used to fund payment activity. Some of these accounts, such as money market deposit accounts and mutual funds, may permit withdrawals of funds by check, often in minimum dollar amounts or in limited numbers. Savings deposits, including money market deposit accounts, retail money market mutual funds, general purpose only, and small time deposits totaled approximately $7 trillion United States dollars at year-end 2010. 11. The EFTA is explained in Section 1.1.2. 12 small time deposits are issued in amounts under 100,000 United States dollars. Large time deposits, which do not include Eurodollar deposits, are issued in amounts of 100,000 United States dollars or more. 484 CPSS, Red Book 2012. United States. 2.2.1.1 Paper checks. An estimated 22.8 billion checks were paid in the United States in 2010, with a value of 29 trillion United States dollars. 13. In 2009, checks accounted for about 22% of U.S. non-cash payments, compared to 32% of non-cash payments in 2006. From 2006 to 2009, the number of checks paid declined about 7.1% per year, whereas the overall number of non-cash retail payments rose 4.6% per year. Of the approximately 16.2 billion interbank paid checks in 2010, about 8.0 billion, or 49%, cleared through the Federal Reserve banks. In addition, as facilitated by the Check 21 Act, almost all interbank checks in the United States are now truncated and processed in electronic form. By 2009, an estimated 97% of all interbank checks in the United States involved the replacement of the original paper check with electronic payment information at some point in the collection process. In December 2010, about 99.7% of interbank checks received by the Federal Reserve banks were deposited in electronic form, and about 98.4% of the interbank checks delivered by the Reserve banks were presented electronically to the banks on which they were drawn. 2.2.1.2 ACH credits and debits. ACH transactions are a common form of electronic funds transfer used to make recurring and non-recurring payments. There were about 19.1 billion ACH transactions during 2010, representing 38.4 trillion United States dollars, more than twice as many transactions as there were in 2000 and 30% more than there were in 2006. 14 ACH payments may be either credit or debit transactions. In an ACH credit transaction, funds flow from the originator to receiver, and in a debit transaction, as with a check, funds flow from the receiver to the originator. ACH credit payments include direct deposit of payrolls, government benefit payments, and corporate payments to contractors and vendors. Debit payments include checks converted to ACH debits, one-time payments authorized via the internet or telephone, recurring mortgage and loan payments, insurance premiums, consumer bill payments, and corporate cash concentration transactions. 15. In addition, businesses and individuals may use the ACH to make payments to or receive reimbursement from the federal government related to federal tax obligations. Much of the growth in ACH payments over the last decade has been for non-recurring transactions, such as consumer checks that are converted into ACH payments by merchants and billers, and for transactions initiated via the internet or telephone. 2.2.1.3 Credit cards. Credit cards combine a payment instrument with a credit arrangement. Some 21.4 billion credit card transactions were processed during 2010, valued at 2 trillion United States dollars. General-purpose credit cards are generally issued by a bank under a license from a payment card network, such as Visa or MasterCard, and typically involve a revolving credit agreement. There were 18.9 billion general-purpose credit card transactions during 2010, valued at 1.7 trillion United States dollars, along with 2.6 billion private label transactions valued at 175 billion United States dollars. 2.2.1.4 Debit cards. Among non-cash payment types, debit cards grew the most over the past decade and have replaced checks as the most frequently used non-cash payment instrument in the United States. These cards draw funds from a cardholder's transaction account, for instance, a 13 inferred from the 2010 Federal Reserve Payments Study, www.frbservices.org/files/communications/pdf/. Press/2010_payments_study.pdf. 14 See the 2010 Federal Reserve Payments Study. 15 Corporate cash concentration transactions are generally those initiated by an organization to fund, or to consolidate funds, from its branches, franchises, or agents. CPSS, Red Book 2012-485, Transaction Account at an Issuing Bank. Some 43.8 billion debit card transactions were processed during 2010, valued at 1.6 trillion United States dollars, compared with 26.0 billion processed during 2006, valued at 1 trillion United States dollars. Debit cards are processed using either single message systems or two message systems. A single message system is based on ATM POS network technology that combines authorization and clearing into one step, in which transactions are usually authorized by entering a personal identification number (PIN) into a merchant's online terminal. A two-message system is based on credit card processing systems, in which the authorization is completed in the first step and clearing is completed in a separate second step. Over 60% of debit card transactions were authorized using a two-message system, virtually all of which were processed over the Visa and MasterCard networks. In 2010, there were 14 single-message networks. The majority of single-message payments were processed over the Visa and MasterCard single-message networks. Prepaid cards have also grown substantially over the past decade. Prepaid cards facilitate access to non-traditional financial accounts. These cards include general-purpose reloadable cards, sometimes used as a substitute for a traditional bank checking account, and payroll and government benefit transfer (EBT) cards issued to take the place of paychecks and government benefit checks. Prepaid cards include specific purpose restricted use EBT cards provided by governments, private label and general-purpose gift cards issued by retail merchants and card networks, and rebate cards. In 2009, prepaid cards were used for 6.0 billion transactions valued at $142 billion United States dollars. Of these, there were 2.7 billion private label prepaid card payments, 1.3 billion general purpose card payments, and 2.0 billion EBT card payments valued at 44.7 billion United States dollars, 42.8 billion United States dollars, and 54.5 billion United States dollars, respectively. 2.2.2 Section 1075 of the DFA directs the Federal Reserve Board to issue rules relating to debit card interchange fees, network exclusivity arrangements, and transactions routing. The Federal Reserve Board's Regulation 2, Debit Card Interchange Fees and Routing, implements these provisions. Interchange fee limitations do not apply to credit cards, issuers that, together with affiliates, have less than 10 billion United States dollars in assets, debit cards issued pursuant to government-administered payment programs, or certain general-use prepaid cards. Covered issuers are permitted to receive an interchange fee up to a cap comprised of 21 cents per transaction plus 5 basis points of the value of the transaction. These issuers may also receive a small upward adjustment to the cap to account for fraud prevention costs. In addition, the board has prescribed rules prohibiting network exclusivity arrangements and routing restrictions in connection with electronic debit card transactions. In particular, all debit cards, regardless of the size of the issuer, must have at least 2 unaffiliated networks associated with them. Interchange fee regulation. 3. Payment systems, funds transfer systems. 3.1 General overview. In the United States, funds transfers occur primarily through the Fedwire Fund Service, CHIPS, the National Settlement Service (NSS), check clearing, ACH, and payment card networks. 486 CPSS, Red Book 2012. United States. 3.2 Large value payment systems. There are 2 major large value funds transfer systems in the United States: I, the Fedwire Fund Service, operated by the Federal Reserve, and E, CHIPS, operated by the Clearing House Payments Company LLC. These payment systems are used by depository institutions and their customers to make large value, time-critical U.S. dollar transfers. In addition to the Fedwire Fund Service, the Federal Reserve also operates the National Settlement Service, which allows for multilateral settlement by clearing houses, financial exchanges, and other clearing and settlement groups. 3.2.1 Fedwire Fund Service. 3.2.1.1 Institutional Framework. The Fedwire Fund Service, Fedwire Funds, owned and operated by the Federal Reserve Banks, is a real-time gross settlement system that enables participants to send and receive final payments in central bank money for their own accounts and on behalf of customers. Under the Federal Reserve Act, the Federal Reserve Board is responsible for general supervision and oversight of the Reserve Bank's provision of Fedwire funds. 3.2.1.2 Participation. An institution that maintains an account at a Federal Reserve Bank is allowed to be a Fedwire Funds participant. Institutions with accounts at a Reserve Bank may access the Fedwire Funds Service subject to the conditions detailed in Operating Circular 6 and the PSR policy. These institutions include Federal Reserve member banks, non-member depository institutions, and certain other institutions, such as U.S. branches and agencies of foreign banks. The U.S. Treasury and other federal agencies also participate in the Fedwire Funds Service as fiscal principals. Some 8,300 participants are able to initiate or receive funds transfers over Fedwire funds. 3.2.1.3 Types of transactions. Participants use the Fedwire Fund service to send or receive time-critical payments for their own accounts or on behalf of corporate or individual clients, to settle positions with other financial institutions or clearing arrangements, and to submit federal tax payments. The Fedwire Fund service processed an average of approximately 497,000 payments per day in 2010. The total value of funds transfers originated during 2010 was approximately $608 trillion United States dollars. 3.2.1.4 Operation of the system and settlement procedures. The Fedwire Fund service is a real-time credit transfer service. Participants originate funds transfers by instructing a Federal Reserve Bank to debit funds from the originator's account at the Reserve Bank and credit funds to the account of another participant. Fedwire Funds processes and settles payment orders individually throughout the operating day. Payment to the receiving participant over Fedwire Funds is final and irrevocable when the amount of the payment order is credited to the receiving participant's account or when notice is sent to the receiving participant, whichever is earlier. Participants can access Fedwire Funds through computer-to-computer and browser-based electronic access services. Participants conducting large volumes of funds transfers typically use the computer-to-computer service, Fedline Direct. Participants conducting small to moderate volumes of funds transfers typically use the browser-based service, Fedline Advantage. In addition, participants can access the Federal Funds service by telephone using the Federal Reserve Bank's offline access channel. CPSS, Red Book 2012-487. The Fedwire Funds operating hours for each business day begin at 2100 Eastern Time (ET) on the preceding calendar day and end at 1830 Eastern Time, Monday through Friday, excluding designated holidays. For example, processing on a non-holiday Monday begins at 2100 Eastern Time on Sunday night and ends at 1830 Eastern Time Monday night. The deadline for third-party transfers, those initiated or received by a participant on behalf of a customer, is 1800 Eastern Time. Offline transfers generally cannot be initiated before 9 o'clock or after 1800 Eastern Time, 1730 for third-party transfers. Under certain circumstances, online and offline operating hours may be extended. 16. 3.2.1.5 Risk Management. Intraday central bank credit in the form of daylight account overdrafts may be available to holders of accounts at the Federal Reserve Banks, including participants in Fedwire Funds, subject to the terms and conditions set forth in the Federal Reserve Board's PSR policy. Fedwire Funds participants may use daylight overdrafts to facilitate payments throughout the operating day. In 2010, aggregate average daylight overdrafts for funds transfers averaged 2.4 billion United States dollars per day, and aggregate peak daylight overdrafts for funds transfers averaged 13.2 billion United States dollars per day, which was about 0.6% of the average gross value of transfers settled each day. Because funds transfers over Fedwire Funds settle in central bank money with immediate finality, credit risk to the receiving institutions is eliminated. To the extent that the Federal Reserve Banks provide daylight credit to a Fedwire Funds participant, they expose themselves to direct credit risk from participants. The PSR policy sets forth controls and other terms and conditions to mitigate this credit risk while providing sufficient liquidity to account holders for making payments. The PSR policy provides for risk assessments, net debit caps and daylight overdraft fees to control and limit exposures of Federal Reserve Banks to their depository institutions while also incentivizing collateralization to limit credit risk. To manage operational risk, the Federal Reserve Banks have a number of procedures in place that ensure the resilience of the Fedwire Funds service, including out-of-region backup facilities for Fedwire Funds applications and all integral support and related functions. The Reserve Banks routinely test the Fedwire Funds business continuity procedures across a variety of contingency situations, including unavailability of facilities, hardware, network or staff, to ensure timely resumption of Fedwire Funds operations in the event of a local, regional or widespread disruption. The Fedwire Funds applications and associated recovery procedures are regularly enhanced and tested to address various emerging risk scenarios. 3.2.2 Clearinghouse Interbank Payments System, CHIPS. 3.2.2.1 Institutional Framework. CHIPS is a real-time computerized system for transmitting and settling U.S. dollar payments among its participating banks. CHIPS is operated by the Clearinghouse Payment Company LLC, Payments Co., which is an affiliate of the Clearinghouse Association LLC, the Clearinghouse. CHIPS is subject to supervision and examination by the Federal Reserve and other federal bank supervisory agencies, under the auspices of the Federal Financial Institutions Examination Council. Also, Payments Co., on the basis of its role as the operator of CHIPS, has been designated as systemically important by the FSOC, and under Title 8 of the DFA, the Federal Reserve is its supervisory agency. 16. A complete time schedule and list of holidays is available in Appendix B of OC6. Additionally, guidelines pertaining to the extension of Fedwire hours are available in OC6. 488 CPSS, Red Book 2012. United States. 3.2.2.2 Participation in CHIPS is available to depository institutions resident in the U.S. that meet the requirements detailed in the CHIPS Rules. 17. CHIPS participants must reside in the United States and be subject to supervision by U.S. state or federal banking supervisors. A non-participant wishing to send payments over CHIPS must employ a CHIPS participant to act as its correspondent or agent. There are approximately 50 participants in CHIPS. 3.2.2.3 Types of transactions. Participants use CHIPS to settle a variety of large-value international and domestic payments, including those associated with the adjustment of correspondent balances, commercial transactions, bank loans and securities transactions. CHIPS processed an average of approximately 361,000 payments per day during 2010. The total value of transfers originated during 2010 was approximately 365 trillion United States dollars. 3.2.2.4 Operation of the system and settlement procedures. CHIPS is a real-time final settlement system that continuously matches, nets and settles payment messages. Payment messages are sent to CHIPS through a multi-protocol label switching network or, as a backup, an integrated services digital network. On a daily basis, the system provides real-time finality for all payment orders released from the CHIPS queue. To achieve real-time finality, payment orders are settled on the books of CHIPS against positive positions, simultaneously offset by incoming payment orders or both. To facilitate settlement, the CHIPS Pre-Funded Balance Account (CHIPS account) was established at the Federal Reserve Bank of New York. Under the real-time finality arrangement, each CHIPS participant has a pre-established opening position requirement, which, once funded via Fedwire funds transferred to the CHIPS account, is used to settle payment orders throughout the day. 18. A participant cannot send or receive CHIPS payment orders until it transfers its opening position requirement to the CHIPS account. Opening position requirements can be transferred into the CHIPS account any time after the opening of CHIPS and Fedwire funds at 2100 Eastern Time. All participants must transfer their requirement no later than 9 o'clock Eastern Time. After a participant has paid its opening position requirement, it is permitted to transfer additional funds, known as supplemental funds, to the CHIPS account throughout the day to facilitate the settlement of priority and non-priority payments. 19. During the operating day, participants submit payment orders to a centralized queue maintained by CHIPS. An optimization algorithm searches the centralized queue for payment orders to settle, subject to restrictions contained in the CHIPS rules. When an opportunity for settlement involving 1, 2 or more payment orders is found, the optimization algorithm releases the relevant payment orders from the central queue and simultaneously marks the CHIPS records to reflect the associated debits and credits to the relevant participants' positions. Submitting participants may remove payment orders from the queue at any time prior to the daily cutoff time for the system, 1700 Eastern Time. Debits and credits are only reflected in CHIPS's records and are not recorded on the books of the Federal Reserve Bank of New York. Under New York law and CHIPS rules, payment orders are finally settled at the time of release from the central CHIPS queue. 17 CHIPS rules are posted on the CHIPS website at http://chips.org. 18 Payments Co. establishes the amount of a participant's opening position requirement using a formula that is based on the latest transaction history of each participant. 19 Priority payments are sent to a receiving participant without regard to certain maximum position limits. CPSS, Red Book 2012-489. At 1700 Eastern Time, CHIPS attempts to match, net and release as many of the remaining payment orders as possible, although no participant is allowed to incur a negative position. As soon as this process is complete, any unreleased payment orders remaining in the queue are tallied on a multilateral net basis. The resulting net position for each participant is provisionally combined with that participant's current position, which is always 0 or positive, to calculate the participant's final net position, and if that position is negative, it is the participant's closing position requirement. Each participant with a closing position requirement must transfer its requirement to the CHIPS account via Fedwire funds in order to release its remaining payment orders. These funds, once paid via a Fedwire funds transfer, are credited to participants' balances in CHIPS. Once all of the Fedwire funds transfers have been received, CHIPS can release and settle all remaining payment orders in the CHIPS queue. Although each participant with a closing position requirement is expected to send a Fedwire funds payment order in the amount of that requirement to the CHIPS account, it is possible that a bank may not do so. In that case, unreleased payment orders remaining in the queue are tallied again on a multilateral basis, adjusted by the addition of amounts from the other participants that have paid their closing position requirements. This procedure allows CHIPS to release as many payment orders as possible. Payment orders still remaining in the queue will expire. 20. After completion of this process, CHIPS transfers to those participants who have any balances remaining the full amount of those positions, reducing the amount of funds in the CHIPS account at the Federal Reserve to zero by the end of the day. 3.2.2.5 Risk Management. CHIPS requires participants to deposit a predetermined amount each day prior to the start of business. During the operating day, CHIPS does not release any payment message from the queue, and therefore does not settle any payment message, unless it can be debited against the participant's current position, and no participant's current position is permitted to fall below zero. CHIPS also caps the maximum positive position that any participant can accumulate. This mitigates against the risk of too much liquidity pooling among a few participants, thus affecting the efficiency of the overall settlement process. All payment messages are final upon release to the receiving participant. Each CHIPS participant is required to have access to sources of credit and liquidity sufficient to pay promptly each day its opening position requirement and its closing position requirement. Participants must be regulated by a U.S. state or a federal bank regulatory authority to ensure that participants are examined on a regular basis and are operating in a sound manner. Each participant is also subject to a credit evaluation by Payments Co. CHIPS participants are required to file copies of their annual financial statements and are subject to a periodic review by the Payments Co. Board. 3.2.3 National Settlement Service (NSS). 3.2.3.1 Institutional Framework. The National Settlement Service, owned and operated by the Federal Reserve Banks, is a multilateral settlement service used to settle for clearing houses, financial exchanges and other clearing and settlement arrangements. Under the Federal Reserve Act, the Federal Reserve Board is responsible for general supervision and oversight of the Reserve Bank's provision of NSS. 20 Expiration of a payment order is treated as if the payment order was cancelled by the sending participant. 490 CPSS, Red Book 2012. United States. 3.2.3.2 Participation in NSS arrangement consists of a designated settlement agent and a group of depository institutions with accounts at a reserve bank that settles for the participants in the clearing arrangement. Each arrangement designates a settlement agent to submit settlement files to a reserve bank on behalf of the settlers. Settlement agents are not required to be depository institutions or to have accounts at the Federal Reserve. Their responsibilities include determination of settlement amounts by settler and electronic submission of NSS settlement files to the Federal Reserve Banks. At year-end 2010, 1,097 active settlers were part of 19 NSS arrangements established by financial market infrastructures, check clearing associations and ACH networks. 3.2.3.3 Types of transactions. NSS files multilaterally settle payments among a group of settlers in the private sector check clearing houses, the private sector ACH network and the securities settlement systems or other clearing houses that use NSS. In 2010, NSS processed approximately 7,000 settlement files and around 520,000 settlement entries. The total value of settlements during 2010 was approximately $14.5 trillion United States dollars. 3.2.3.4 Operation of the system and settlement procedures. NSS provides an automated electronic mechanism for submitting multilateral settlement files to the Federal Reserve Banks. A settlement file contains a listing of the participants, the settlers, either the participant itself or the participant's correspondent, and the dollar amount of the debit or credit to be posted to the settler's account. For each file to be valid, debits must equal credits. If various validity checks are satisfied, the Federal Reserve accepts the file for processing and sends an acknowledgement to the agent. Settlement is final at the point when the settlement file is processed. OC 12 governs settlement over NSS. Each debit on the NSS settlement file is checked against the account balance and intraday credit available to the settlers in their reserve bank accounts to determine if it can be posted. In some instances, debits may be rejected if a settler does not have a sufficient balance or sufficient intraday credit to cover the debit. When all debit entries on the settlement file have been posted, NSS posts the corresponding credit balances. All postings are final and irrevocable when processed. When all credits have been posted, the settlement for that file is complete and an acknowledgement message is sent to the settlement agent. The NSS business day begins at 8:30 and ends at 1700 Eastern Time, Monday through Friday, excluding designated holidays. Under certain circumstances, hours can be extended. Files submitted earlier than 8:30 Eastern Time are queued for processing beginning at 8:30 Eastern Time. 3.2.3.5 Risk Management. Intraday central bank credit in the form of daylight account overdrafts may be available to NSS settlers to mitigate the liquidity risks they face intraday. In addition, immediate settlement finality and the ability for settlement agents to fund settlement accounts using the Fedwire Fund service enable NSS settlers to manage their credit and liquidity risks. The Federal Reserve Banks manage operational risk using the tools discussed in Section 3.2.1.5. The primary source of liquidity risk to participants in an NSS arrangement is the inability of a settler to fund its debit balance. If a settler has insufficient funds to fund its balance, the agent is contacted and must either request that the rejected debit balance be reprocessed, arrange for the amount of the rejected balance to be transferred to the settlement account via the Fedwire Fund service, or cancel the settlement file. CPSS, Red Book 2012-491. 3.3 Retail Payment Systems. 3.3.1 Check Clearing Systems. Depository institutions paid an estimated 22.8 billion checks in the United States during 2010. Approximately 26% of those checks were deposited in the same institution on which they were drawn, i.e., on us, checks, and, therefore, were settled via accounting entries on the books of the paying institution. The remaining 74% were cleared and settled through interbank mechanisms. Approximately 52% of the checks cleared through interbank mechanisms were cleared through direct exchange presentment local check clearing houses and correspondent bank networks. The rest were cleared through the Federal Reserve banks. 3.3.1.1 Operation of the check collection mechanism. In the wake of the Check 21 Act, see Section 2.2.1.1, the vast preponderance of interbank check clearing arrangements are now electronic. Accordingly, much of the infrastructure formerly used to process and deliver paper checks between banks has ceased to exist. For example, as recently as 2003, the Federal Reserve banks managed 45 check clearing centers. By February 2010, the Reserve banks had ceased operations at all but one of these paper check processing centers. The Reserve banks have also discontinued their air transportation networks for checks. In addition, many of the private arrangements for exchanging paper checks, including local clearing houses and ground courier services, have been discontinued. Typically, the first depository institution to receive a paper check truncates that check, using scanning equipment to capture both an image of the check and the information contained in the magnetic ink character recognition (MICR) line printed along the bottom of the check. A paper check may even be truncated prior to its receipt by the first bank that handles the item. For example, in a process known as remote deposit capture, a check's payee, such as a merchant, uses scanning equipment at the point of sale to capture the aforementioned data elements from the paper check and, by agreement, deposits the check electronically with its bank. Once a paper check has been truncated, banks typically handle the item electronically thereafter. A bank may collect an electronic item by depositing it with a correspondent bank or a Federal Reserve bank. Correspondent banks that have established relationships with other correspondent banks may present electronic items drawn on each other directly. Smaller institutions generally use the electronic check handling services offered by clearing houses, correspondent banks, or the Federal Reserve banks. If necessary, as authorized by the Check 21 Act, a bank handling an electronic item may create a legally equivalent paper substitute check for delivery to a subsequent bank or bank customer that does not accept checks electronically. While the Check 21 Act has radically transformed the means by which checks are cleared in the United States, it has not had a substantial effect on the settlement of checks. Correspondent banks settle the checks they collect for other institutions through accounts on their books. Paying banks generally settle with correspondent banks using the Federal Reserve's Fedwire Fund service. Check clearing houses generally net payments. Settlement among check clearing house participants generally occurs through direct transactions between members, through designated settlement banks, or through the Federal Reserve's NSS. The Federal Reserve settles the checks it collects by posting entries to the accounts that depository institutions maintain with the Federal Reserve. The account of the collecting institution is credited, and the account of the paying institution is debited, for the value of the deposited checks in accordance with funds availability schedules maintained by the Federal Reserve, which reflect the time normally needed for the Federal Reserve to receive. 492 CPSS, Red Book 2012. United States. Settlement from the paying institutions. Collecting institutions usually receive credit on the day of deposit or the next business day. 3.3.2 Automated Clearinghouse ACH is a nationwide electronic file transfer mechanism that processed 19.2 billion credit and debit transfers initiated by depository institutions through electronically originated batches during 2010. The Federal Reserve is one of the nation's two ACH operators. The Clearing House's Electronic Payments Network (EPN) is the sole private sector ACH operator. 3.3.2.1 Operation of the ACH system. The Federal Reserve maintains centralized application software used to process ACH payments submitted to the Federal Reserve banks through the FedEx system. Depository institutions electronically deliver files to and receive files from the Federal Reserve banks through a variety of electronic access options. EPN and the Federal Reserve banks rely on each other for the processing of ACH transactions in which either the originating depository institution or the receiving depository institution is not their customer. These inter-operator transactions are settled by the Federal Reserve. ACH transactions processed by the Federal Reserve are settled through depository institutions' accounts at the Federal Reserve. Settlement for ACH credit transactions processed by the Federal Reserve banks is final when transactions are posted to the receiving depository institution's accounts, which is currently at 8:30 Eastern Time on the settlement date. Credit for Federal Reserve ACH debit transfers is not final at settlement. Credit for debit items is available to the originating depository institution on the settlement date but is not final until the banking day following the settlement date. FedEx is governed by Operating Circular 4, which, subject to certain exceptions, incorporates the operating rules of NACHA, see Section 1.3.2. Transactions processed by EPN are settled on a net basis using the National Settlement Service. 3.3.3 Payment card networks. Credit card and debit card networks provide communications, transaction authorization and interbank financial settlement for financial institutions. Payment card networks establish uniform operating policies, procedures and controls. Some major networks are publicly traded companies. The largest credit card and signature-based debit card networks in the United States are Visa and MasterCard. American Express and Discover are also major card networks. There were also several smaller debit card networks operating in the United States during 2010. 3.3.3.1 Operation of payment card networks. Credit card and debit card networks sort and route transaction data from acquiring banks to issuing banks over proprietary networks. The networks generally settle on a net basis with the acquiring and issuing banks daily, although typically with a 1 or 2 day lag between payment initiation and settlement. Generally, the networks use the acquiring and issuing banks' aggregated transaction information to compile each bank's net settlement position. Member banks may be required to maintain collateral with the networks, settlement banks to manage default risks. Acquiring and issuing banks may settle directly with each other, through regional settlement banks or through the Federal Reserve or by other net settlement arrangements. The settlement process can vary significantly, depending upon the banks involved. CPSS, Red Book 2012-493. 4. Systems for post-trade processing, clearing and settlement. 4.1 General overview. In the United States, a number of systems facilitate the post-trade processing, clearing and settlement of securities, derivatives and other financial transactions. These currently include trade repositories as well as central counterparties, central securities depositories and securities settlement systems. 4.2 Trade repositories. 4.2.1 DTCC Data Repository, US LLC. 4.2.1.1 Institutional Framework. DTCC Data Repository, US LLC DDRLUS, is a wholly owned subsidiary of the Depository Trust and Clearing Corporation, DTCC, that operates a multi-class swaps data repository for the over-the-counter OTC equities, credit, interest rate and foreign exchange derivatives markets. DDRLUS plans on supporting commodities derivatives in the future. DDRLUS maintains an electronic database containing authoritative and timely data on derivatives contracts for the asset classes that it serves. 4.2.1.2 Participation. DDRLUS provides open access to all participants in these OTC derivatives markets, including swap execution facilities, designated contract markets, derivatives clearing organizations (DCOs), confirmation providers, and middleware providers in an effort to promote processing and regulatory reporting efficiency. 4.2.1.3 Types of transactions. DDRLUS is part of DTCC's Global Trade Repository (GTR) service that supports cleared and uncleared OTC equities, credit, interest rate, foreign exchange, and commodity derivatives. The GTR service is utilized by two other trade repositories in addition to DDRLUS: DTCC Derivatives Repository Limited (DDRL Limited), a UK company, and Global Trade Repository for Commodities BV (GTRFC), a Dutch company. GTR is serviced by other DTCC subsidiaries, including the Warehouse Trust Company, a state-chartered, limited-purpose trust company in New York and a member of the Federal Reserve System, that provides post-trade lifecycle event processing to trade repositories servicing the credit default swap market. DDRLUS also has links to the DCOs that choose to satisfy CFTC swap transaction reporting requirements under the Commodity Exchange Act. 4.3 Central Counterparties, CCPs, and Clearing Systems. 4.3.1 National Securities Clearing Corporation, NSCC. 4.3.1.1 Institutional Framework. The National Securities Clearing Corporation provides central counterparty clearing and settlement services for various securities transactions in the United States. NSCC is a wholly owned subsidiary of DTCC and is registered as a clearing agency with, and subject to regulation and supervision by, the SEC. Also, NSCC has been designated as systemically important by the FSOC, and under Title 8 of the DFA the SEC is its supervisory agency. 494 CPSS, Red Book 2012. United States. 4.3.1.2 Participation. NSCC participants include brokers, dealers, banks, other clearing agencies, investment companies, insurance companies, and other similar entities. NSCC clears transactions for a number of exchanges, electronic communication networks (ECNs), and other trading venues. These trading venues include the New York Stock Exchange (NYSE), the NASDAQ stock market, and regional U.S. markets, as well as OTC markets in municipal government bonds and other securities. 4.3.1.3 Types of transactions. NSCC provides clearing and settlement services for broker-to-broker trades involving equities, corporate and municipal debt, American depository receipts, exchange-traded funds, and unit investment trusts. In 2010, NSCC processed around 20 billion transactions, valued at approximately 218 trillion United States dollars. 4.3.1.4 Operation of the system. NSCC functions as a CCP for the equities and corporate and municipal bond markets. Equities trade over exchanges or ECNs, corporate and municipal bonds trade over the counter. Trading activity, regardless of trade source, enters NSCC on trade date T, and final settlement occurs 3 days after T plus 3.21. In its clearing process, NSCC conducts a multilateral net of its members' trade positions, resulting in a net long buy or net short sell position in each traded security for each member and a single overall net funds position for each member. NSCC maintains a settlement account at the Depository Trust Company, DTC, to allow settlement of net securities obligations. 22. On settlement date T plus 3, NSCC's Continuous Net Settlement (CNS) system instructs DTC to deliver available securities from members with net delivery obligations to NSCC's settlement account and then deliver those securities to members with net receive obligations. These securities deliveries are made free of payment within DTC and are provisional intraday, with respect to the receiver, until end of day payment approximately 16:30 Eastern Time, as made over NSS.23. The DTC and NSCC end of day net funds settlement process is executed over a single NSS file. Each DTC and NSCC member must designate a settling bank that participates in the DTC-NSCC-NSS arrangement. DTC and NSCC calculate a net funds settlement obligation for their common members by netting their separate DTC and NSCC net funds obligations. 4.3.1.5 Risk Management. NSCC establishes requirements for participants' financial resources and creditworthiness. Financial requirements are generally based upon the entity type of a participant, e.g., broker, dealer, bank, trust company, etc., types of services that the entity will use, e.g., full use of continuous net settlement, limited use of non-guaranteed services, etc., and whether the entity intends to clear transactions for others. In addition, NSCC maintains sufficient resources, primarily member clearing fund deposits, to cover the failure of the member, including the member's affiliated family, having the largest net debit in extreme but plausible market conditions. NSCC's clearing fund calculation includes daily mark-to-market charges, which measure the unrealized profit or loss in participants' portfolios using contract prices versus market prices of the securities that NSCC clears. 21 trade information sources include automatic transmission from exchanges and ECNs. 22 settlement over DTC is described in Section 4.4.2. 23 deliveries to members with net funds credit positions, sell obligations greater than buy obligations, will be final intraday once successful delivery of sell obligations has occurred. CPSS, Red Book 2012-495. NSCC's liquid resources include participant cash contributions to NSCC's clearing fund and the cash that would be obtained from NSCC's committed liquidity facility with a consortium of banks. When drawn upon, the committed liquidity facility would be collateralized with participant securities contributions to NSCC's clearing fund, and unpaid CNS long allocations are collateral supporting those allocations of the defaulting member. Securities in NSCC's clearing fund consist of U.S. Treasury and agency securities. In the event that a member fails to pay its net funds obligation to NSCC, the CCP is obliged to make payment to its surviving members for the securities they delivered to NSCC to be undelivered to the failing member. NSCC would need to draw on its liquid resources and/or convert the delivered securities, which the DTC system would make available to NSCC, and/or its other financial resources, into cash to make this payment. If losses are incurred in the liquidation of a defaulting member's positions, NSCC would first use that member's clearing fund deposit to cover a loss incurred on the liquidation, and any funds available from any applicable collateral sharing arrangements with other clearing corporations. In the event that a defaulting member's clearing fund deposits were insufficient to cover the liquidation of all positions, NSCC would draw from resources available under applicable cross-guarantee agreements and from no less than 25% of the retained earnings attributable to NSCC. If a deficiency still remained, NSCC would satisfy the deficiency by utilizing the clearing fund deposits of surviving members and assessing its members as provided in its rules. The assessment process, in general, allocates any remaining losses pro rata among members based upon the member's usage of the service to which the loss relates. 24.